moving averages, MACD, Bollinger Band squeeze. Now all these are simple strategy that they use to predict the market's reversal, and one thing I know for sure is that all these indicators, they are a bit late when trying to predict the market trends. Now when I mean late, even 10 seconds late can mess up the whole trading plan for the day if you place a trade, and most indicators often lag, giving you signals later or earlier on than what is said on the chart. Now that's why for me the most reliable source for trading and predicting trend reversals is using highly effective price action patterns. Now these patterns are very exclusive, as we are going to study them in depthly in this video. I'm going to be giving you my top 5 price action patterns that I use to spot trend reversals without lagging or missing what the price has already given us. Now this is based on my own knowledge and on my own backtest and personal trading, and I can be saying that I have been trading for a long time and backtesting all these patterns for a long time. Now I will go with a countdown of 5 to 1, and 1 is obviously the most effective, while 5 is the least effective, but all are also effective in the long run if you comply. Watch the video to the very end and learn how to trade them, why traders fail when using them, and how to be profitable using these price action strategies. With that said, welcome to TradeFox. Welcome back to TradeFox, guys. Now before we dive into any price action pattern, right here we need to talk about the basics of reversal. Now what is reversal exactly for the beginners? Now this is where market changes its bias, whereby from an uptrend it changes to a downtrend, or a downtrend it changes to an uptrend. Now our key level take is to find specific zones where this price interacts and changes this direction. That is where we are going to find our trade entries, which leads us to the 5th price action strategy, which is the consolidation box. Now the consolidation box is price movement, basically moving sideways without a certain direction. It's just hitting support, resistance, support and resistance till eventually a breakout occurs. Now 3 things I learned when trading consolidation boxes: 1, they are very effective; 2, they work better on higher time frame; and 3, you need some sort of confirmation when trading this powerful strategy. Now being number 5th doesn't mean it is not effective or less effective, because most traders use this strategy very well, and it's just on this list that is making it to number 5. Now how do we know a consolidation box is valid? Simply check if the price is moving sideways and it has up to 3 touches. Right here you can see 1, 2, 3, which leads us to a total of 6 touches, 3 in the resistance and 3 in the support zone. Now once that happens, we know that our consolidation box is a real consolidation box. Now if we take a look outside here, we can see a fake breakout that occurred. How do we spot this fake breakout? Because some people might take their trade thinking that it is a breakout from a consolidation box. Now that is where we are going to use some price action to check. As we can see right here, after price broke, price retested but couldn't pass the previous high, making it a loss in momentum. So that is an invalid trade right there, and an invalid setup to take our entries. Also we can see with the previous range, the consolidation box didn't touch specifically 3 times, it touched twice, which here we can see 1, 2, and the upside it gave us 1, 2, and we can see 3. So but anyway, let's move on to how to trade this consolidation box. Now, first of all, we can check our chart and we see that we are in the uptrend. We were in the uptrend and a consolidation box appeared. Now, if it breaks to the upside, we know price is going to continue its trend upward. While if it breaks downwards, we know that there is a potential reversal in the market. And as we can see, price gave a strong break right here. Price gave a strong break in the consolidation box, leading us to know that this consolidation box is broken. Once we see that, we don't certainly place our trade. We have to make sure price reverses inside the consolidation box back. What I mean by inside, right here we can see a retracement to the middle line of the consolidation box. This is where we take our sell orders or sell entries. We open a short position and our stop loss slightly above the consolidation box. Take profit 1, the first zone right here, which I can see clearly is this zone, and take profit 2. We drag it all the way down to the second zone right here, which is this zone. So as we see that our confirmation box is already broken, it gave us a breakout and it gave us a nice retest. We click on the indicators tab to check our confirmation, which is the volume. When we click on the volume profile, we can see right here that most of the volume were in the consolidation box, meaning that once price breaks it, there is going to be a big downtrend in the long run, because the large amount of volume that was in the consolidation box is being taken out. So let's see how the trade goes by. Okay, we can see our take profit 1 has been touched and price is still going within that zone. Let's see if our take profits 2 will be touched. Market still hovering, playing around, and we can see that the volume is changing. Most of the volume that were in the consolidation box are being taken out. Okay, price is still playing around and not wanting to touch our take profit 2, but there's still a lot of volume, so there is still a good means that price will touch our take profit 2. Still hovering around. Now when most traders see price almost reaching their take profits and reversing on them, they feel so afraid and they leave the market, which is one very bad thing to do as a trader. Trust your trading plan, trust your trading strategy, and you won't regret it in the long run. There is still a lot of volume in the market and I still expect price to go down. And as you can see, our take profit 2 was hit easily. See, price is still going down and is making a new trend basically, because it's giving us lower lows, lower high, lower low, lower high, lower lows, lower highs, and we can see that price has changed drastically. So before we move on to the next pattern, let's quickly do a summary on what we learned in the consolidation box. First of all, for a consolidation box to be valid, it needs to have at least 6 touches, which is 3 up in the resistance and 3 down in the support. It has to have a clear breakout and a good retest rather, and it must have large amount of volume in the box when it is broken. Now, once all these our conditions are met, we are good to place our trade and have no fear and watch how this strategy is going to predict the trend reversal in the market without lagging. Now, with that said, let's move to number 4. Okay, on number 4, we have the dominant candle break. Now, this strategy is really awesome to predict trend reversals and price reversals. Now, they don't basically predict, let me say, long-term price reversals, but they give a certain motion that price is going to revert in that particular point. Now, to be specific, we have certain targets we must take profit in this strategy when using dominant candle break to be able to get at least a little profit during the trend before it might turn against us. Now, most people might use this dominant candle break probably as a confirmation for other strategies, because you can use it as a candlestick confirmation, but I used to use it to trade reversals. This is an example of a dominant candle break. It is where 2 or more candles break one candle. Like, for example, we are in the downtrend and we want to move to the uptrend. 2 bullish candle or 3 bullish candle is going to break and close above 1 bearish candle right here. Why the same scenario implies to the uptrend, once 2 or 3 bearish candle breaks and closes below a bullish candle, then we know that it is a dominant break occurrence. Now, once this happens, we wait for the price to close fully before we use our Fibonacci tool. The 0 point should be at the wick, the lowest wick entirely of the dominant candle break formation, and the 100 level should be at the body of the last candle that broke and closed above the bearish candle. Now, right here we can see the Fibonacci has given us certain levels which we have to obey when trading using this strategy. Okay, for dominant candle break, the golden ratio for taking profits are the 161 and the 261. Now, you can also ride for longer period of time, because basically this is a trend reversal indication that price is going to change to another trend. So let's place our trade. We enter our buy position. Right at the close. Right at the closing of the candle, take profit 1. Stop loss should be in the 141 level of the Fibonacci. Then we have our take profit 2, which is going to be the 261. Stop loss 141. Now why the stop loss is in the 141 zone is that that is the limit for dominant candle break reversals. Now once price reverses to certain ranges inside this box, we still take retest trades, but once it closes past the lowest level, which is the 141, then we know that price has potential to fail in the long run. Now let's see how this market plays and how the bullish dominant candle break works. Okay, our TP1 has been touched. Price took a little retest and we entered here. We can re-enter right here over to our second target, which was highly touched. As we can see, the touched target as well, but we didn't really pay attention to that side. So guys, we can see that price changed direction once this bullish dominant candle break appeared. I have a full crash course on dominant candle break. I'll drop the link in the description, or you can just click on the video right on the screen to watch it and understand the various concepts on how to trade the dominant candle break. Now let's look for a quick bearish example. Okay, we can see one so far right here. Three candle closing below this bullish candle right here. Once that happens, we take our Fibonacci tool, 0 to the tip and 100 to the shadow, to the body that closed below the candle, the bullish candle. Our TP1 was touched, but unfailingly our TP2 and TP3 were not touched. Well, this is just because while studying the bullish candle break and the bearish dominant candle break, I noticed that they don't predict long-term price reversals such as the consolidation box, but so far they are more effective for trading, day trading as a beginner. That is why they are on the spot number 4 in this strategy. Now let's look forward to the next number, which is number 3. The third price action pattern on my list is the head and shoulder. Now hold up before you fast forward this strategy, because I know you might be thinking that, oh, I know the head and shoulder very well. Traders often fail this strategy very well now because they don't use simple rules when trading the head and shoulder. Now if you apply this rule, I promise you the head and shoulder is a very effective strategy when predicting price changes in the market. Now for example, let's say we see that this is a downtrend, obviously, and we have a head and shoulder right here. How do we know it is a head and shoulder? It consists of 2 peaks and a head. The 2 peaks being the shoulders, then the head. Our confirmation for head and shoulder is that it has to break through the neckline before we can have a valid entry. So let's see what price did. You see, price closed perfectly above the neckline. So this is a valid entry right here. So we take our buy position take profit, stop loss, right here. Now, one reason most traders fail when using head and shoulder patterns is that this price action respects zones very well. So this zone are marked right here. If you go to the higher time frame, this is 15 minutes by the way. Let's say we go to the 1 hour. Okay, right here in the 1 hour, we can see that there was no zone right here. So we may be thinking that okay, let's place our take profit in this 1 hour zone. We need to know that head and shoulder pattern is going to respect the lower time frame zones before heading to the higher time frame zones. So when taking your take profit, we need to set it according to lower time frame zones, then we can scale it up to higher time frame zones. Not you just putting your trade and hoping that it will reach the higher time frame zones without any other information. No, I don't know what's wrong. Okay. Okay, so we can see the head and shoulder broke a strong neckline. The first zone right here, we can see a zone right here, then the higher time frame zone. Our take profit should always be the first zone to avoid getting out of the trade if the price didn't reverse fully. So let's see how this plays out in the long run. Okay, price still hovering around. Another thing to note is when trading head and shoulder pattern, there must be a retest. Not actually must, but there will be a retest. There will be a retest in price and is a good decision to trade the retest. Price still hovering. Now we have our retest. We enter another long position right here. Target still the first zone. Price is still soaring, and you can see our TP was touched perfectly. Another thing to note when trading head and shoulder is the confirmation. For me, I personally like using RSI as a confirmation, and I can also use volume profile as a confirmation to trading the head and shoulder pattern. As you can see, there was a lot of volume when price broke out of the neckline. So when trading the head and shoulders, make sure that price touch the smaller time frame zone, which you should use as your first TP before scaling it out to touching the higher time frame zones. That is one way to trade the head and shoulder reversal strategy. Now moving on to number 2, let's see what we have for the price action trading strategies. The next price action strategy is the divergence. This strategy is very effective in all time frame works on all stocks, forex, crypto, but I personally trade divergence using the awesome oscillator. Now, trading divergence alone cannot be possible. It is the formation of using an indicator and price action as well to locate potential price changes and price trend movement. Now, divergence is when the price contradicts to what the indicator is doing. For instance, price is making higher highs, while in our confirmatory indicator, for me I'm using awesome oscillator, is doing lower highs. Once this occurs, we know that there is a divergence and there is potential price change to happen. We only place our trade when the lowest part of our divergence is being broken. So we take our short position, stop loss slightly above the divergence, and our take profit is going to be the first visible zone right here. The first visible zone right here is going to be our take profit, and for our take profit 2, we can target lower zones right here. Short position. Right here. Now, when trading divergence, always take profit and don't just hold divergence expecting price to just be skyrocketing and going higher. That is why most people trade when using divergence. I also have a full video on divergence. You can click the video right on the screen, or you can check the link in the description below. Now let's see how this price plays out. Okay, we can see that the divergence was highly respected. Okay, TP1 touched. Let's see. Hope price is not turning back on us. Okay, TP2 touched. That is the power of trading divergence. Now, divergence is very, very powerful if you really know how to trade divergence and you really know the concept of trading divergence. That is why it is the number 2 on the list of these price action reversal strategies. And let's head up to the final and the most effective so far, number 1. Now, for number 1, we have the Quasimodo pattern. Quasimodo pattern is a very, very effective pattern for identifying trend movements and potential trend changes in the market. It is very, very efficient and effective, and it works on all time frame, all pairs, and all commodities you can think of trading. Now, why do I say this Quasimodo is very effective? In different terms and different concepts, as traders have their different concepts. For some, it can be called the Quasimodo pattern, while for most people that are trading the smart money concept and other type of concepts might call it the break of chalk structure in the market. Now, let's see how this Quasimodo pattern is. Price makes higher high, makes a low, makes another high, makes a lower low, then comes back to the left shoulder. Now most people, they confuse themselves by thinking the Quasimodo is head and shoulder. Well, I won't really battle that right here because I have created a video on Quasimodo, everything you need to know. Link in description, or click the video right to watch it and understand how to trade Quasimodo very well. Now for example, this is a bearish Quasimodo. Price makes first peak, then the middle peak, which is the highest. There must be a break of structure to confirm the Quasimodo. Right here we can see a break of structure. Then we should expect to enter our trade at the left hand corner. Take our short positions right here. Stop loss slightly above the Quasimodo. Then take profit. 1 is going to be the first zone, and take profit 2 is going to be the lower zones right here. Now this is basically a bearish Quasimodo pattern, and it is crooked in nature, must follow a break of structure, and let's see it on a real chart. Okay, right here we can first see that market is in a downtrend. How do I know? Market's making lower lows, higher low, lower low, higher low, lower low, higher low, lower low. Why I'm using this tool? Now that's just to show that we are in the bearish market. Now as we can see right here, this is the latest high, which got broken. Now once that kind of thing happens, we should expect a Quasimodo pattern, as we have had a break of structure. Now price has broken. We have ourselves our higher high and a lower low. Our point of interest is going to be the left hand peak. So we expect price to make a retracement towards this zone and bounce up towards maybe this zone. Remember, we need to take profit in smaller zones first. So we will target this zone and this zone right here. If the Quasimodo works out very fine. Let me clean all these lines. Okay, let's see how this works out and plays in the market. Okay, here we have our retest and the Quasimodo has been triggered, so we take our long position. If market is in a downtrend and the Quasimodo forms, is going to the upside. We take our long position, stop loss slightly above below, and take profit 1. Clean this. Right there. And I'll take profit 2. Which is going to be this zone right here. Let's see how this Quasimodo works out. Okay, TP1 touched and TP2 touched perfectly. As you see guys, Quasimodo is very effective, and I recommend you watching my video on Quasimodo pattern, how to trade Quasimodo very well. I also talked about different concepts on trading Quasimodo pattern. Now I hope you liked this video and you were educated. Please subscribe and support TradeVox. May your trading journey be prosperous. May you, using any strategies on TradeVox, be profitable in the long run. With that said, see you in the next video. Peace.